Okay, let's unpack this. Welcome to the deep dive, where we take these uh, dense financial documents and really try to extract the most important nuggets of knowledge and insight just for you.
Yeah, and today we are diving deep into Aflac Incorporated's quarterly report. It's the Form 10Q for the quarter ended June 30th, 2025.
Hmm.
And, this isn't just some dry filing. It's really a window into how a major global insurer like Aflac navigates, well, complex market forces and manages its huge multi-billion-dollar operations.
Absolutely. Our mission today is to cut through the jargon, understand the core drivers behind Aflac's recent performance, and maybe uncover some fascinating details about how a company this big manages everything: investment risk, currency fluctuations, you name it. We want to help you become truly well informed.
And trust us, the headline numbers, they tell a story, sure.
Yeah.
But the real intrigue, as always, is buried in the details.
Right. So the big question, I guess, hanging over Aflac this quarter is how did a company with, such a solid core business see its reported earnings just plummet so dramatically? And the answer I think we'll find lies deep within their investment portfolio and their global operations. It's quite a case study in financial resilience, actually. So let's start with those headlines then. Looking at the second quarter of 2025, Aflac's total revenues were $4.2 billion. That's down from $5.1 billion same quarter last year.
Yeah, a noticeable drop.
And net earnings, they took a significant dip. I mean, falling from $1.8 billion in Q2 2024 down to, what, $599 million in Q2 2025?
Just under 600 million.
That's a massive shift. So what was the primary driver behind this?
Well, it's a really critical distinction here. The main reason for this huge shift wasn't actually a downturn in their core insurance business itself. What we're really seeing is primarily a swing from net investment gains back in 2024
Okay.
to significant net investment losses in 2025. Just look at the 6 months ended June 30, 2025. Those net investment losses hit $1.4 billion. Compare that to gains of $1.6 billion in the prior year period. So it really underscores that for global insurers, investment performance isn't just, a nice-to-have extra. It's often the dominant driver of their reported earnings, sometimes even outweighing a strong underlying business performance.
Okay, so if it wasn't the core insurance side, what specifically caused these big investment losses?
They were largely driven by net losses from certain derivative and foreign currency activities. Those accounted for $452 million in just Q2 2025,
Oof.
and an even larger $1.3 billion for the first 6 months of the year. Now, there was also an increase in credit loss allowances and some impairments too. Like, for example, there was a $6 million impairment on an office real estate property. That was due to a, quote, material adverse change in occupancy.
Ah, okay, sign of the times there.
Yeah, perhaps. But this was partially offset by some gains from increasing fair value of their equity securities. So a mixed bag within investments, but the derivatives and currency really hit hard.
Right. And you mentioned those derivative losses were tied to foreign currency. Now, Aflac has this massive footprint in Japan, right? I imagine currency fluctuations must play a huge role. How does that global presence specifically impact these reported figures, especially with the yen?
That is such a key distinction when you're analyzing a multinational like Aflac. See, Aflac Japan reports in Japanese yen. That's its functional currency.
Right.
So all their local transactions, results, everything is measured in yen first. But because Aflac is a U.S. company, those yen results, they have to be translated back into U.S. dollars for the overall company report.
Makes sense.
And when the yen weakens against the dollar, which it has at times, the reported results in dollars just look lower.
Even if they're doing okay in Japan.
Exactly. Even if performance in yen terms is actually strong, this translation effect is a critical factor. You can really see how it heavily influences the overall financial picture here.
Okay. And speaking of getting a clear picture, Aflac also uses some adjusted financial measures. We see this a lot. Why do they do that? What do those adjusted numbers tell us that the standard, U.S. GAAP numbers don't?
Yeah, that's a crucial point for really understanding their performance beyond the headlines. Aflac provides these non-US GAAP measures like adjusted earnings and adjusted book value.
Mm.
They do it precisely because they want to highlight the underlying profitability and trends of their core insurance business, kind of separate it from all that market noise.
Okay.
So these adjusted figures, they exclude items that are largely outside management's direct day-to-day control. Things like volatile market movements, certain derivative impacts that aren't really tied to the core operations, maybe infrequent events like they had that pension settlement charge back in Q1 2025 that gets excluded too.
Ah, right.
So it's basically their way of offering you, the observer, a more consistent view of their operational performance, stripping out some of that volatility.
Got it. Okay, let's shift gears a bit. Let's talk about Aflac's investment strategy. Since they're an insurance company, how do they approach building their portfolio? It's not like a hedge fund, I imagine, just chasing returns.
Exactly. No, their core strategy is very specific to being an insurer. They invest primarily in fixed maturity securities. So think bonds, mostly.
Right.
The goal is to provide a reliable, predictable stream of investment income. That's key. Their main goal isn't really to generate gains from actively buying and selling securities. It's much more focused, heavily focused actually, on asset liability matching, or ALM.
Asset liability matching. Okay, what does that mean exactly for an insurer?
Well, it means making sure the timing and the nature of their investment returns are ideally perfectly aligned with when their policyholders are going to need to be paid their benefits. So if they have long-term policy obligations stretching out decades,
Which they do.
which they definitely do, they need long-term assets generating predictable income over those same decades. It's like balancing a really complex checkbook, but on a massive multi-billion-dollar scale across many, many years.
That makes perfect sense. So what does their actual investment portfolio look like then? And how do they account for it? I think I saw a mention of amortized cost.
Yeah, so their fixed maturity portfolio, it shows a strong focus on high credit quality. 68.5% of the amortized cost is in A-rated securities. Pretty solid.
And amortized costs, just quickly?
Right. Think of amortized cost as basically the original purchase price of a bond, but it's adjusted over time for any premium or discount they might have paid when they bought it. It gives a much more stable view of their long-term investment value compared to just looking at daily market fluctuations.
Which is crucial for an insurer holding assets to maturity, right?
Exactly. They plan to hold most of these bonds until they mature, but importantly, they also hold some below investment grade securities. Junk bonds, technically.
Oh, okay.
Well, it's a deliberate strategy. It's to enhance their overall yield, get a bit more income, and also to further diversify their credit risk. But it's done within a very controlled framework.
Right. And these examples mention, like Thames Water Utilities showing an unrealized loss, or Telecom Italia SpA with an unrealized gain. Are these just random examples, or do they tell us something specific about their strategy? How do they manage these kinds of holdings?
They're illustrative, yeah, but they also highlight how Aflac's active management comes into play. While the bulk of the portfolio is high grade, these specific holdings show their selective sort of foray into higher yield, maybe more complex instruments.
Okay.
And the fact that they manage the unrealized gains and losses on these internally, well, that speaks to their dedicated credit analysis teams. It shows their approach to diversifying risk while still trying to seek out some enhanced returns where they think it makes sense.
Okay. Now, speaking of their Japanese portfolio again, I saw a reference to something called reverse dual currency securities. That sounds interesting.
It does, doesn't it? Yeah, these are pretty unique, mainly in Aflac Japan's portfolio. So imagine a security where the principal, right, the initial amount invested and what you get back at the end, that's paid in yen.
Okay.
But the interest payments, the coupons you receive throughout the life of the security, those are paid in US dollars.
Huh. Why structure it like that?
Well, it allows Aflac Japan to better match its yen-denominated liabilities. The future payments they expect to make to their Japanese policyholders, which are in yen.
Right. Match the principal.
Exactly. But at the same time, they can secure potentially higher yields from the dollar interest payments, which are typically higher than what's available on standard Japanese government bonds.
Ah, clever. Trying to get the best of both worlds there.
It's a way to manage their currency exposure on the liability side while boosting income a bit.
Okay, so given the complexity of some of these investments, like maybe those reverse dual currency ones or the below investment grade bonds, how do they actually determine their fair value, especially for assets that aren't traded on a big exchange every single day?
Yeah, this brings up a really crucial point about financial reporting and estimation.
Yeah.
Aflac uses what's called a fair value hierarchy. It's got 3 levels. Level 1 is the easy one. It uses quoted prices in active markets. Think stocks traded on the New York Stock Exchange.
Straightforward?
Level 2 uses significant observable inputs. So maybe prices for similar assets, interest rates, things like that, still based on market data.
Okay.
But level 3, that's where it gets trickier. It relies on significant unobservable inputs,
Unobservable. Seeing what?
meaning inputs that aren't readily available from active markets. Management has to develop these inputs themselves. So for these level 3 assets, think certain complex mortgage-backed securities or maybe equity stakes in private companies. AFLAC uses techniques that require significant management, judgment, and estimation. They might look at things like credit spreads over benchmark rates or get offered quotes from brokers who deal in these less liquid assets, or even analyze the private financials of the companies themselves.
Wow. It really makes you think about how much estimation can go into a financial statement, even for a huge company like this.
It absolutely does, especially in those level 3 buckets.
So, just thinking from an investor's perspective, how much weight should you put on these level 3 asset valuations? Does it introduce a sort of hidden risk or uncertainty?
It's a sharp question. It's important to understand. Now, typically, level 3 assets are a relatively smaller portion of an insurer's overall portfolio like AFLAC's, but their valuation does introduce a degree of subjectivity, no doubt about it.
Right.
It's not necessarily a higher risk in terms of the underlying asset defaulting, although that's possible too, but it adds complexity to interpreting the financial statements because their reported value is more dependent on management's models and estimates than on, readily observable market prices.
Okay.
It's why savvy investors often scrutinize the disclosures around level 3 valuations pretty closely in reports like this 10Q. Look at the assumptions, the methodologies.
Got it. So, with all this market risk, these estimations, the global operations, how does AFLAC actively manage these exposures? I assume derivatives must come into play quite a bit here.
That's correct. Derivatives are a key tool in their risk management toolkit. AFLAC uses derivative instruments primarily to manage two main things: foreign currency exchange rate risk, which we talked about, and interest rate risk. So, for instance, AFLAC Japan hedges its U.S. dollar-denominated investments back into yen. They use instruments like foreign currency forwards and options to try and minimize the impact of those yen-dollar fluctuations on their results.
Okay.
And the parent company, back in the U.S., also does something interesting. It designates some of its yen-denominated liabilities, maybe debt issued in yen, as what's called a non-derivative hedge for its net investment in AFLAC Japan. It's another way to manage that overall currency exposure at the consolidated level.
It sounds incredibly complex, like a financial tightrope walk.
It is complex, yes, but maybe think of it less like a tightrope walk and more like a carefully choreographed ballet. Every instrument, every move has a specific purpose in managing the overall risk profile.
That's a good analogy. Now, do all these derivatives they use actually count as hedges in accounting terms? Does that matter? How does that work?
Good question. No, not all of them necessarily count as hedges for accounting purposes, and yes, it does matter for how the results are reported. Some derivatives do qualify for what's called hedge accounting. These can be designated as cash flow hedges, fair value hedges, or net investment hedges, depending on what risk they're managing.
And what does qualifying mean for the financials?
When a derivative qualifies for hedge accounting, the gains and losses on that derivative, or at least the effective portion of them, are typically reported in other comprehensive income, or OCI.
OCI. That's part of equity, not the main income statement, right?
Exactly. It bypasses the main income statement, at least initially, and goes directly to the equity section of the balance sheet. The idea is to smooth out earnings volatility because these hedges relate to future events or specific assets being hedged, not necessarily the current period's operations.
Okay, so what about the derivatives that don't qualify?
Right. So other derivatives either don't meet the strict criteria for hedge accounting, or sometimes the company simply elects not to designate them as hedges. Maybe it's too complex to document. For those derivatives, the changes in their fair value are reported directly in current period earnings.
So they contribute to those net investment gains or losses we talked about earlier, the volatile part.
Precisely. They become part of that number, contributing to the swings we saw this quarter.
Okay. And what about the risk of the other party on these derivatives not paying up? Counterparty risk.
That's always a consideration, but is largely mitigated these days. They have collateral posting requirements, meaning counterparties have to put up cash or securities depending on the value of the derivative. And they also make significant use of central clearing counterparties. especially for more standard derivatives, which further reduces that direct counterparty risk.
Okay, that makes sense. Let's maybe zoom in now on the actual operational segments. How did Aflac Japan and Aflac US perform individually if we try to strip out some of that investment volatility we've been discussing?
Right, looking at the core business, let's start with Aflac Japan, their biggest segment by far. Their net earned premiums actually decreased a bit.
Oh, why was that?
Two main reasons cited. One was an internal reinsurance transaction they did, and the other is something inherent to their product mix. Limited pay products reaching their paid-up status.
Okay, explain limited pay and
Yeah,
beta.
sure. So limited pay policies are ones where the customer pays premiums for only a set number of years, maybe 10 years, 20 years, something like that.
But the coverage lasts much longer.
Exactly. The insurance coverage might last for their whole life. Once those premium payments are finished, the policy is considered paid up. The customer doesn't pay any more premiums, but Aflac still has the obligation to pay out benefits if a claim occurs later.
Ah, so naturally, as more policies become paid up, the premium income from that block of business declines over time.
Precisely. It's an expected runoff for those specific types of policies. Also, their adjusted net investment income in Japan decreased a bit, partly due to the yen strengthening against the dollar during certain periods within the quarter, which impacts the translation of non-yen investment income back to yen for the segment reporting.
But what about new sales? Are they still selling well in Japan?
Actually, yes. Despite those factors, their new annualized premium sales increased significantly,
Yeah.
up 23.2% in yen terms for Q2 2025 compared to last year.
Wow, that's strong growth.
It is. And remember their massive footprint there. Over 22 million policies in force in Japan, including 14 million cancer policies alone. They're dominant in that market. And they distribute their products through 358 banks, covering about 90% of all the banks in Japan. So the distribution network is vast.
Okay, so Japan's core sales engine seems strong, even with those premium dynamics. What about Aflac US?
Aflac US actually saw net earned premiums increase.
Okay.
That was driven by growth initiatives, particularly in their group products insurance sold through employers. And their sales also increased, up 2.7% in Q2 2025.
So positive momentum in both key markets on the sales front then.
Yeah, it seems so. While the overall investment results definitely face headwinds, the core insurance sales showed positive signs of both Japan and the U.S. It really highlights that the underlying operational engines are, still running pretty strong.
Okay, good perspective. Now, beyond the income statement numbers, how does Aflac make sure it has enough cash, enough liquidity to meet all its obligations, pay claims, and also pursue growth? What's their sort of financial fortress look like?
Well, fundamentally, the company consistently generates positive cash flows from its operations. That's the bedrock.
Right. Cash coming in from premiums consistently.
Exactly. And they manage their capital very carefully. They maintain a target minimum capital buffer of $1.8 billion at the parent company level that's specifically held for stress conditions, providing a cushion against unexpected negative events like market shocks or large claims.
And how much cash do they actually have on hand?
As of June 30, 2025, they held $7.0 billion in cash and cash equivalents across the company. So a very healthy liquidity position.
Where does the parent company get most of its cash from?
Aflac Japan, being the largest and most profitable segment, provides the largest source of liquidity back to the U.S. parent company. That comes primarily through management fees and dividends paid up from Japan.
Okay. And what about returning capital to shareholders? You mentioned the investment volatility. Did that impact their buybacks or dividends?
It doesn't seem to have slowed them down significantly, no. In the first 6 months of 2025 alone, they returned $2.3 billion to shareholders.
$2.3 billion. How?
Through a combination of treasury stock purchases, buying back their own shares and paying dividends, they repurchased 16.4 million common shares in that period.
Wow.
And they also just declared a dividend increase of 16% for the third quarter of 2025.
A 16% increase, even with the lower net earnings.
Yep. It really shows a strong commitment to shareholder returns, and it signals management's confidence in their long-term financial health and cash generation ability, even when dealing with short-term market fluctuations affecting reported earnings.
That's a strong signal indeed. Okay, finally, are there any sort of key regulatory considerations we should be aware of, especially given their global reach, things that influence how they operate?
Yes, regulation is always a huge factor for insurers. Very much so. In Japan, Aflac Japan has to meet a specific requirement called the Solvency Margin Ratio, or SMR.
Solvency margin ratio, what is that, basically?
It's essentially a measure of their financial strength, relative to the risks they take on. It ensures they have enough capital to meet future policyholder obligations, even under stress. And this SMR is sensitive to market changes, like interest rates and investment values.
So how do they manage it?
They use specific strategies, like something called policy reserve matching, which involves aligning their assets more closely with specific blocks of policy liabilities to manage that SMR volatility.
Okay. And in the U.S.?
In the U.S., they're primarily regulated at the state level. They're subject to State Guarantee Association laws. These laws basically protect policyholders if an insurer happens to become insolvent. Other insurers chip in to cover claims.
Right.
But the report notes that the assessments Aflac had to pay for these guarantee funds were immaterial in the periods presented, so not a major financial impact currently.
Okay. So wrapping things up then, you've just taken us on a really deep dive into Aflac's recent financial performance. We've kind of peeled back the layers, haven't we? Seen how those headline earnings can be so dramatically influenced by factors beyond the core operations, especially for a global business like this.
Absolutely. We've unpacked the nuances of their investment portfolio management, everything from focusing on credit quality to that sophisticated and sometimes quite subjective process of measuring fair value for less liquid assets.
Yeah.
And hopefully you now have a better handle on how those extensive hedging strategies work to try and mitigate risks like currency fluctuations and why those accounting adjustments we discussed actually matter for understanding the underlying story.
Yeah, and we've seen how their operational segments are actually performing, showing resilience and even some good growth, particularly on the sales side, and how they maintain that robust liquidity and capital strength, which allows them to weather market volatility and, importantly, keep returning value to shareholders through dividends and buybacks.
It really does show that a major insurer's financial health is this complex interplay, isn't it?
Yeah.
It's strong operational execution combined with a disciplined investment strategy and some very shrewd risk management. All of that happening under the watchful eye of regulators globally. It's a fascinating look at the kind of financial artistry, if you will, required to manage a global insurance giant like Aflac.
Definitely. So our final thought for you, the listener, to maybe mull over. How might Aflac's recent experience with these significant investment losses driven by market shifts influence their long-term strategy? How will they balance that need for yield enhancement against mitigating risk, especially if we continue to see global economic uncertainty and currency volatility?
And maybe also, how might the ongoing evolution of accounting standards themselves, things like how derivatives or fair value are treated, impact how we, as informed observers, interpret their financial narrative in the future? Will the picture become clearer or perhaps more complex?
Lots to think about there. Thanks for joining us for this deep dive. Until next time, keep learning.